Hi, this is Mike Sheehan at financialprof.org. Let's talk about mortgage protection. Now, I want to say right from the get-go, PMI, private mortgage insurance, is not mortgage protection. If I have this discussion once, I have it a handful of times when I'm sitting down with somebody. They're reaching out and they said, I asked them about, do you have something to cover the mortgage? And they go, oh yeah, we have it through the bank. And we find out it's PMI. PMI, private mortgage insurance, is to protect the mortgage company. And you'll have that added to your mortgage when you put down less than 20%. So if you happen to put down more than 20%, it's not even a conversation. So let's go back to mortgage protection. So what this is an amount of life insurance. It is a form of life insurance that you can purchase to cover the mortgage. So in the event of a death, and some have riders that can help in a case of disability, either the mortgage payment in a case of disability could be paid monthly, or that the entire mortgage can be paid off. And it's a great tool because, for 90% of people, the mortgage is their largest debt that they have. And it would change their world if something were to happen to one of the spouses and they weren't able to keep up with the mortgage and they had to sell the house. There's nothing worse than having to sell something in what we call a fire sale, where you have to sell it. You're never going to get what it's worth, nor would you want to add more frustration, anger, pain to your family of having to move because you weren't able to keep up the mortgage. So mortgage protection, mortgage insurance can be purchased. It's usually purchased in a 20-year or 30-year lengths, depending on your mortgage. Some of them have a really neat feature where they have return of premium. So let's say it's a 20-year policy that you purchase. At the end of the 20 years, you're going to get 100% of that money back. 100% of your premium will come back. So it's like you got the coverage for free. And what some people will do, let's say they had a 30-year or 25-year mortgage, that money that they got back on that premium, that might be enough to pay off those other 10 years, which is kind of cool. Might not pay all of it, but it could put a good chunk into paying off that balance on that. Or someone will just take that money and put it in a side account. But in any case, that's called return of premium. So should you have it if you have a mortgage? Absolutely. If you want to know more about how it will work for you, go to financialprof.org. If you liked what you heard, you want to hear more, make sure to like, subscribe, and share. Turn on the notifications, and then you'll never miss another bit of our content as we release it in the future.